Hi everyone. I'm Nikki. I'm with Lawyer's Title, and I'm so excited that you guys are joining us today. I think this is going to be a really great class all about 1031 exchange. And I brought in Greg Burns. He is with IPX1031, and he's a Southern California native, a senior vice president with Investment Property Exchange Service Inc. He has 25 years experience. He's assisted with thousands of clients, tax advisors by providing proven and cutting-edge solutions that help clients achieve their goals. So I think he's going to be somebody really great to have in our network in PV to help us with 1031 exchange. And he's just going to be going through his talk today. And any questions that you have, please feel free to jump in. But I'll turn it over to Greg.
Thanks, Nikki. So, my name is Greg Burns, as you guys know. I work for a company called IPX 1031 or Investment Property Exchange Services Inc. Since we have such a long name, we kind of abbreviated it down to IPX. I've been with the company for 28 years. Our company's been in business for a little more than 30. We are wholly owned by a company called Fidelity National Financial, which also owns Nikki's title insurance company. So our companies are sister companies. And that's going to be important, and I'll talk about that importance of that as we kind of go down the road. I want to talk a little bit about market conditions. Nikki and I were kind of talking about what's going on in your local markets before you guys jumped on. The exchange market is actually better than you would think. Last month I did 207 1031s for my customers. The month before that I did 211. So I'm doing a little bit more than 200 transactions per month. And so, in a market where I have very good agents calling me and sending me emails like, hey, are you seeing the market slowing down? Because it seems like I'm not busy. There's still a lot of exchanges. And I think there for a couple reasons. So one, we've had a significant amount of appreciation over the last, not in the last couple years, but the years preceding up to, let's say, the last couple years. And so people have seen, that have owned properties for 5 or more years have seen pretty significant gains in their properties. And so I get calls from clients all the time, probably at least a couple a month that say, hey, I need to do a 1031 on this rental property that I own. I didn't know anything about 1031, but I was talking to my accountant. He told me how much I was going to have to pay in taxes. And so he told me about 1031. So I really want to do an exchange because I don't want to pay the taxes. And so that's a conversation that I have quite a bit. A lot of people are, that sell are, just not thinking about the tax ramifications. And so yesterday I was actually on the phone with a customer because we're talking about 1031, right? We're talking about deferring taxes, right? And so you kind of have to have a basic idea of what someone would pay if they decided to sell. Now, an agent called me yesterday, was asking me some questions, kind of a newer agent. And then he got to the point of where he was like, the client wants to know what their tax liability would be if they decided not to exchange. And so what I told them is this: you are not their tax advisor. You do not do their tax return. You don't have access to their tax return. So you are not qualified to tell them what they're going to pay in taxes. But it is always good to give them a answer, right? So like the answer in this case should certainly come from their CPA. A answer is okay. So what I told them is at a minimum, they're going to pay 24.3%. So that's 15% federal, 9.3% state. That's the lowest taxes you could pay. But based on how much depreciation they've taken on the property, how big their gain is, what their income level is, all of those things can increase that. And most of my clients end up in the low 30s percent range as far as taxes go. So if somebody came to me and said, oh, well, what should I try to figure in taxes? I would say somewhere between, probably depends on the deal and how long they've owned it. But I typically tell people somewhere between probably 30 to 33%. And so that is a good answer. And then just direct them back to their CPA. So the idea is like, okay, because some people think, oh, well, I got to pay 15% in taxes because they think long-term capital gains taxes are 15%, which is not necessarily the case because there's recapture depreciation tax. There's healthcare taxes if your gain exceeds 250,000. There's also the state tax, which is between 9.3 to 13.3%. Anytime that I've ever really drilled down with a customer on what they would pay in taxes, they just get confused. So what I tell clients is at a minimum, you're going to pay 24.3%, but based on how much depreciation you've taken, what your income level is, how big the gain is, that number is going to probably go up into the 30s. And then I just stay away from it. So then the client goes, okay, well, I definitely don't want to pay taxes, so I want to do an exchange. And it's important to remember that 1031 is a federal tax code, so it covers all of the US, and it's a tax deferral system. So it's not like you're doing tax-free exchanges. So I'll give you guys kind of a funny example. So I had a client about 4 years ago. She sold one property. She did a 1031 exchange. She bought two replacement properties to complete her exchange. And about a year and a half after she completed her exchange and bought these new properties, she called me. She said, "Hey, Greg, I'm wondering how long I have to hold this property before I could sell it." And I said, "You want to sell it and do another exchange?" And she said, "No, no, I just want to sell this one property, cash out." And I'm like, "Well, you could sell it anytime you want." She said, "Well, why would they let you do that?" I said, "Why would they let you do what?" She said, "Well, why would they let you do a 1031, buy this new property, and then just immediately sell it and not pay any taxes?" And I said, "I didn't say anything about not paying any taxes, right? So the taxes are still there. You've just deferred them into that property." So a question will come up a lot with your clients. They'll say, "Well, if I'm only deferring the taxes, aren't I just kicking the can down the road?" Which essentially is true. You are kicking the can down the road. But the idea is that I can take money that I would normally pay in taxes and use it to go make more money with if I want to go continue to buy real estate. It's always an interesting conversation that I have with customers where I'm like, I'll talk to them and say, "Hey, I'll get a client that calls me and says, "Oh, I think I just want to cash out," and then I'll ask them the question, "Well, what did you invest in?" And this is literally a conversation I had a week ago with a client. They bought a deal and they were selling it for like 1.2 million. And I said, "How much did you pay for the property?" They said, "Oh, I paid 365,000." I said, "So now it's worth 1.2 million." They said, "Yeah." I said, "What did you invest in that made you that much money?" They're like, "What?" And I'm like, "Did you buy? Was there anything else that you bought?" And they put, I think, $70,000 down when they initially bought the property. Says, "Is there anything that you put $70,000 into that is now worth 1.2 million?" They're like, "God, no, not even close." And I'm like, "So you got the most appreciation, the most wealth building in real estate's asset class, and now you're thinking about selling it and taking the money and doing what with it? Why would you move out of one of the greatest asset classes that exist, if it's made you the most money?" And a lot of people are like, "You know what? I didn't really think about that. I just was thinking that I would sell it, pay my taxes, put the money in the bank, and earn a little bit of interest there." But you're right. Like, why am I taking the money out of the market? So so that's why people exchange is because they can use the money to be in a market where they've made usually most of their money, a big chunk of it. And also there is so they say there's like two things in life you can't avoid, right? Death and taxes. But there are some taxes that you can avoid, right? By dying. We call it the swap till you drop program. So you exchange throughout your lifetime. When you pass away, your heirs get a step up in basis, which eliminates the taxes. So if you exchange throughout your lifetime, you pass away, and in California, since we never outlive our wives, my wife, when I die, will get a full step up because it's a community property state. So I really essentially am leaving more money to her. I had a client not that long ago that was like, "Oh, I'm going to sell these assets and put the money in the bank so my wife doesn't have to deal with it." And I'm like, usually when I hear that, they're just kind of tired of managing assets and dealing with tenants and all that kind of stuff. But there are passive investments, and we'll talk about those, that they can put the money in and still, and really leave more money to their heirs. It says, so I think 1031 also a good estate planning tool. Um, Another thing that comes up with 1031 quite a bit, and we're seeing it more now than I've ever seen in my career, is that people are buying properties for their kids. I just talked to a client last night that was doing it. They, 1031 exchange out of a property. They're going to buy a property up in Northern California where their daughter lives, and their daughter is going to be their tenant. And so there's no issue with that. The rules say that they have to pay if you're renting to a family member, they must pay fair market rent. I had a client not that long ago, sold some property in Tennessee, has a daughter that lives in Orange County. She's a school teacher, a single parent, single mom. And he said, I'm going to buy a house for her there, but she can't pay fair market rent. And I said, well, those are what the rules are, talk to your CPA, see if there's a way that you can mitigate that. And I thought he came up with a really interesting way to kind of help get around that. So he said, okay, well, I'm not going to charge her, like the exact amount of rent that I could get. Like, so if the place was supposed to rent for $4,000 a month, I'm going to charge her $3,000 a month because it's a reasonable amount of rent. There are still people that are paying that kind of rental rate that are third parties. Okay. He said, but what I'm also going to do is I'm going to pay her a property management fee every month to live there and manage the property. I'm also going to pay her for any maintenance fees on the property. So if she changes a light bulb or she fixes something or whatever, she's working on something, all of those are going to get paid back to her. And that's a way that I can lower her rent. So in theory, I thought it was a good way of, getting away from having to pay exactly fair market rent. But I'm seeing more parents do that now than I've ever seen. And the reason is because I think people are at a point now where they're saying, listen, I don't want to wait till I die, and to give this money to my kids. I would rather see them, benefit from it now. I mean, Nikki and I were talking earlier, is that it's very hard for young professionals, even if you have a good job, even if you're making good money, to be able to afford a house or even a condo because the market has just gone up so much in value. They talk about, I mean, I saw this guy talking about how much, someone could afford. And it was like talking about almost 60% of their salary, or their income going to like a house payment. And I was like, that seems crazy to me that that much would go towards the payment of a house. So you're seeing parents saying, listen, I don't want to see my kids struggle. Why don't I just benefit them now? And I do this now. So that's something that we're seeing a lot of people do. People are also buying, homes that they ultimately want to live in. Now, remember, when we're talking 1031, it's only investment or business use property. So properties that don't qualify, your primary residence. That's covered under a completely separate section code. That's section 121, which says, hey, if you live in a property for two of the, last 5 years, you can take 250 tax-free if you're single or 500 if you're married, right? And then uh, uh, second homes, the government feels like if you're wealthy enough to own a second home, you don't need a tax break. Vacation homes that are not rented out do not qualify. It's a personal use property. So anything that's like a personal use, it doesn't qualify. But there are, it doesn't say that you have to hold in a property as an investment forever. So let's say you have a client that goes, oh, I want to sell a property in the area and I really want to retire or have a second home in Palm Desert, right? So they sell the property here, in LA County. They 1031 exchange it. They buy a property in Palm Desert. If they hold that property in Palm Desert as an investment for at least 2 years, after that, they can do whatever they want. So there's a revenue procedure out there that says any property that's been held as an investment for 2 years or more in an audit, the IRS can't challenge the held for investment portion of the exchange. So as long as they hold that asset for 2 years, after that, they can kind of do whatever they want with it, right? So we're seeing a lot of people do that. And they're buying properties in different states, Idaho, Texas, Tennessee, lots of different places. So we're seeing a fair number of that. The other thing we're seeing people 1031, passive investments. So people are getting tired of the terrible T's of real estate, right? The tenants, the toilets, the taxes, the termites, all the fun things that are associated with managing property. And they are looking for, real estate investments that make them passive investors where they don't no longer have to manage real estate. So there's two basic things that we see people going into. One is called a triple net lease, which allows them to basically, you guys see them all over, right? You see like Walgreens, Dollar Tree, Jack in the Box, McDonald's, Chase Bank, uh, you know, um, uh, Tractor Supply, Starbucks, great example. So Starbucks is not in the real estate business. They're in the coffee business. Well, technically, I think they're in the sugar business because if you look at how much sugar's in their drinks, that's why they're so good. Um, but they're in the coffee business, right? But they want to act as the true owner of their property, right? So what they do is they sign these triple net lease agreements. So every Starbucks that you see is owned by an investor. None of them that I'm aware of are owned by Starbucks. I don't know if they have, maybe they have some corporate owned stores, but I'm not really aware of any. So the way it works is that this client, right, this investor, they own the Starbucks. But Starbucks signs a triple net lease, which makes them responsible for the maintenance in the property. They carry the insurance in the property. They're also paid the property taxes. So it's net of all fees. So your client gets a rent check from them, right? They pay their mortgage if they have one, and what's ever left over is theirs. They don't have any management responsibilities. So a pipe breaks, not their problem. Someone gets all hopped up on cappuccinos and drives into the Starbucks, not the owner's problem. Starbucks is the one that carries the insurance on it. They're also the one that's responsible for doing the maintenance in those deals. So it's become a very popular form of ownership. I When I first started, I knew one person in Encino that sold those types of investments. And they were really sold really to big institutions. You weren't seeing like mom and pop, owning those. Today, I know probably 500 agents that only sell that product type. So it's become a big segment of the market. I would say 10 to 20% of the people that we have that are selling like apartments are transitioning from apartments into these net lease investments. There's another kind of passive investment that we're seeing a lot of people go into too, which is called a DST or a Delaware Statutory Trust. And what a DST is that there's these real estate companies that go out and they buy a large asset or a portfolio of assets. And then they sell small fractional interests in those properties. So they buy an asset or a bunch of assets, let's say for 50 million, some are 75 million, some are 35 million. It runs the gamut. There's one deal right now in the market that's 400 million. Um, and then they sell off small fractional interests in that big asset. So, like an example is that there was a self-storage deal. It was made up of 16 properties in Texas. So there was 16 self-storage facilities that they combined into this portfolio. And a client could buy a small fractional interest in it. Their minimum investment was 250,000, and they would pay, I think they pay 5.5% return on it. And so clients invest in that deal. They get 5.5% every month get sent to them, well, whatever they invest in it. And then they typically sell those assets every 5 to 7 years. And then, once they sell them, they have the ability to do another exchange into another DST if they want, or they can go into their own property, or they can cash out. So that's become a very popular form of ownership. Now, why am I talking about these alternative investments? I'm talking to you about them is because if you're talking to an investor about, hey, I see you own this, rental property in PV, and you've owned it for, I don't know, 15 or 20 years, are you tired of managing this asset? Have you thought about, and typically the other thing about that, when you own properties in highly appreciated, very expensive markets, the cash flow return that people get on those, the amount of equity that's in that property is very low. So I would guess if you looked at that rental market that you guys are in, and looked at the return on equity that people are getting actually on their property, I bet it's less than 2%. And so as people are looking to retire, right, one of the things that people are looking at is how do I replace my income? Well, the way that you do that is not through appreciation, right? Because the markets that you guys are in, PV obviously one of the, very desirable place to live, highly appreciates all that kind of stuff, but not great for cash flow purposes. And so if I'm retiring, right? If I can go from making 1.5% on my money in this rental property and don't have to manage to 5% or 5.5 or 6%, that's a huge net income plus to me, right? And so you're seeing people that are doing that. Now, the question comes, how do I find these investors? I mean, in any given market, 25 to 30% of that market is non-owner occupied properties. And I can tell you how you can find it. There's a lady that's kind of right next to me on the board here that can help you find those non-owner users. So, Nikki, do you want to talk about like how you can look at farms and how you can create those and that kind of stuff?
Definitely. So we have two different farming tools that we offer. One is called Farm in Here and one is called Dynamic Farm. And these farming tools are great because it not only shows turnover rate, so you can use it for your real estate business. Say you're trying to find people that are looking to buy or looking to sell just their property that they personally live in. But what's nice is that we also have a filter in both of our farming tools that allow you to look at absentee owners or non-owner occupieds. Those are people that have a different mailing address than the address that's listed in the farm area. These people are great to target because it's likely a renter that's in that property. It's likely somebody that, maybe lived in that property prior, but now they have another property that they live in, and they might be looking to get rid of it, like Greg said, and look into one of these other investment types so that they're able to make some more money. The other thing that I've seen with non-owner occupieds is a lot of them live out of state. So they maybe used to live here, they moved out of state, and they might not want to hold on to that property anymore. So if you're looking for these types of investors, reach out to me. We can set up a time to look through the farm areas and figure out where those non-owner occupieds are located so that maybe you can get in touch with those investors to see if they're ready to move that money that's in that property into a different type of investment.
I love what Nikki just said there. So Nikki and I did not talk about this really before this class, and I can tell you that she said something that I want all of you guys to key in on. She said, "Hey, if there's investors that are out of the area that live in different locations, we can locate those investors." Now, if I became a real estate agent tomorrow, the very first thing that I would do if I was farming to investors is I would look for investors that no longer live, especially in California, that still own real estate here. They are huge targets because real estate management from another location is very challenging. The other thing that it is the regulations that California and LA County have in place are very tenant friendly. And so, those calls should go like, "Hey, I see you own this property here in PV. I see you've owned it for many years. Was it used to be your primary? Tell me about it because I see that you live in Tennessee now. And is it challenging for you to manage that asset from Tennessee? Are you having challenges with, rent control, with some of the new landlord rules are in place, and have you ever thought about selling that property here and 1031 exchanging it into a property closer or properties closer to where you live? So it's easier for you to manage those assets and actually, and probably get way better cash flow. Because the reality of it is that, you guys are operating in a very expensive market. And so, areas where real estate is less expensive, typically the income, the cash flow is better. So those would be people that I target. And it's something that I've talked about. I've been doing these seminars for 28 years, but it's something that I've talked about that she picked up on, which I think is amazing about it is, marketing to, non-owner users that are outside the area. I think that that's, the number one thing that I would go after if I was looking to do some marketing. So, so that's on that side. I want to talk a little bit about like kind, because I know we've been talking about these kind of concepts, and we're going to get into the nut and bolts of what a 1031 kind of looks like from an agent perspective, so that you guys feel comfortable going through the process. But there's this term in 1031 that people, talk about called like kind, and it really is kind of a misnomer because when you're doing a 1031, right? Like kind simply just means Is it real estate? And did I hold it for investment or business use? And am I going to buy real estate that I intend to hold for investment or business use? The asset class of the real estate doesn't matter. And the reason that I wanted to kind of bring this up is because I have had literally probably hundreds of phone calls over the years from people that are saying like, oh, well, I'm selling this vacant land. I wanted to go use the money to go buy a condo, but my CPA said I've got to go buy more vacant land because that's like kind. That is absolutely not true. You could sell vacant land, you can buy improved property, you could sell improved property, you could go buy vacant land, you could sell residential, you could go buy commercial, you could sell a business use property. So I had a client that called me maybe 2 years ago, maybe less. And he said, hey, Greg, I'm selling my business, which includes the land and the building. And my CPA said I can't exchange the real estate part of it because I didn't pay myself rent. That is absolutely false. And he would have paid a huge tax bill. Now, he cannot exchange his business. So he was selling the goodwill of his business. He was selling the machines that made the product of his business. Those don't qualify. Those are considered, not real estate. So they don't qualify for the 1031. But certainly the value that was allocated to the land and the building, that absolutely qualifies. I've got a client right now that I talked to yesterday. She's in a 1031. She is out looking for property. She's like, oh, I'm really having a tough time finding property. Um, I'm thinking maybe I'll just go buy a commercial deal and then move into it and then just pay myself rent. I'm like, you don't need to pay yourself rent. She's like, what? I'm like, there's no requirement in 1031 that the property produce income to qualify for an exchange. It's if you move into it, as long as you don't live there and you run your business out of it, it's a business use property. You do not need to pay yourself rent. She was like, wow. So I think she's kind of turned her idea, and I think she's gonna, they own a construction company. I think she's just gonna buy a building and run her company out of it. So so I want you guys to understand like-kind rules for 1031, very broad, right? So, basically, is it real estate? Am I holding it for investment or business use? But I did say something that I kind of want to talk about a little bit is that I mentioned that a property doesn't have to produce income in order to qualify as an investment, right? So vacant land doesn't produce income, qualifies as investment. But what if you had a client that said, okay, I want to sell a property, uh, you know, in LA County, and I want a 1031 exchange it, and I want to buy a property in Palm Springs or Palm Desert, and I'm going to hold it as an investment for 2 years, but I don't want to rent it out. I'm just going to, not that's not going to work. So if somebody buys and I'll give you guys a great example of it. I had a client that sold a McDonald's. They did a 1031 exchange. They bought a $10 million home in Beverly Hills. And for 2 years, he just renovated the house. He did not, rent it out or whatever. He's like, yep, for 2 years, I'm just going to keep it vacant. I've got my other primary residence. I'm going to report that as my primary. I'm not going to live there. I'm just going to rehab the house. So after 2 years, he moved into it. And then the franchise tax board audited him in year three. And they basically disallowed his exchange. They said, you didn't hold this as an investment. You bought this property, you renovated it for 2 years, and then you moved into it. You had no intention of holding it as an investment. So it is very important that if you have a client that wants to do that, that they truly treat that new property as an investment. Now, the question comes up all the time. Do I have to rent it out full time? You do not. You can VRBO it. And the rules say a vacation home qualifies as an investment if you rent it out for at least 2 weeks a year at fair market value, and you don't use it for more than 14 days a year for personal use. So, interestingly enough, I had a client that did a 1031. They used the proceeds from the sale to buy part of the proceeds to buy a condo in Hawaii. And about 3 or 4 months after they completed their exchange, the wife called me up and said, hey, Greg, the property in Hawaii, I have 90 days of rental income on my books. I said, well, that's great. And she said, is there any way that I could spend more time there, than the 14 days that they allow without getting in trouble? I want to play by the rules. And I said, well, anytime that you spend there doing maintenance or making improvements doesn't count against your 2 weeks. So for the first 2 years, she did a lot of maintenance and made a lot of improvements on that property. So you just need to document that, for that. So that's something to kind of keep in mind. Now, let's kind of drill down to kind of the nuts and bolts of what a 1031 looks like, because I don't want you guys, we've been talking about concepts and like kind rules, but let's talk about like what, you know, a 1031 would look like if you were trying to list it for sale and kind of how that process would go. So let's say you talk to an investor, you're talking to them about selling their, let's say, duplex that they own, that they've owned for many years. And the question comes up like, oh, I know in a 1031, I only have 45 days to find a replacement property. And I'm concerned that, I won't be able to find a property I want in 45 days. And I can tell you that's the hardest part of the exchange. The hardest part of a 1031 is finding the property that you want to buy within that 45-day period. So as an agent, it is an objection that you may have to overcome to get a listing. And so the way that I basically explain it to a customer is like this. So it is 45 days, but that's from the date that escrow closes. So the reality of it is we're going to have, let's say, a 30 or 45-day escrow, and there's going to be probably a 17-day financing and inspection contingency. So 17 days after we open escrow, once they release those contingencies, you can kind of add that onto your onto the 45 days, because we can aggressively start making offers before your sale even closes, right? Because you guys have that 17-day, financing contingencies and inspection contingencies built into your contracts anyway. So you can say, listen, 20 days before your sale closes, we'll aggressively start making offers. So you can add 20 days onto the 45 days you already have. So that gets you like 65 days, really, right? And they go, well, 65 days still doesn't seem like a lot of time. Well, what if we do this? What if we, accept whatever, we negotiate whatever terms we're going to negotiate on the sale, but we also ask for one 15-day extension. So if we get to the close of escrow, you haven't found the property that you want to buy, you have the right to exercise that extension to buy yourself 15 more days. And they go, well, 15 days plus 65, that's like 80 days, feels like 90 days, like 3 months. We could probably find some in 3 months. So that is a good tool that you guys can use. So the client goes, okay, great. I want to sell my property. They sign your listing agreement. So, you go to the office, you start inputting it into the MLS, or you order the pictures or whatever you're going to do. A lot of people ask the question, if I know that the seller is going to be doing a 1031, should I put that in the comments? My opinion is no. And let me tell you why. 1031 is not a condition of sale, right? So, the buyer doesn't have to cooperate with the seller's exchange in order for it to qualify. And so I would not put that in the listing agreement. And so I would just list it just like you would any other deal. Now, one of the other things that you should do before you get this property listed for sale is you should reach out to Nikki and order a preliminary title report. Nikki, why don't you talk about how you do that? Maybe some of the things that you're looking for on a prelim to make sure that there's no issues, when you get it.
Yeah, totally. So when you get that listing agreement signed, I say reach out to me immediately. Let's get that prelim looked at. I've seen prelims that have a bunch of things that need to be fixed, unknown liens that we didn't know existed. Sometimes it's child support liens. We never know what we're going to find on that preliminary title report. So let's look at it first thing so that we can get everything squared away. So once you open escrow, you're good to go. And that also takes stress off of your client, because sometimes there's unknown contingencies that they're stressed about, and having something on the prelim that needs to be fixed also can be stressful. The other thing that I would suggest is before you get the prelim, Chat with me about the listing that you're going on the listing appointment, and let's pull the property profile. Reason being is that we need to make sure that everybody that is vested on the property is signing that listing agreement for you. I've seen it where there's trustees to a trust that we didn't know existed, and they're in remote Alaska, and we need to get in contact with them. We need time to do that. So, the second that you're going to start the listing process, let's talk. Let's get everything sorted out so that we can check the prelim, we can check the property profile, we can figure out who needs to sign, and we can fix any problems that we see on the prelim before we even get to market, before we get to escrow, so that you're all good to go. Yeah, I think that's the main things that I check on a prelim. Also, just so that all of you know, I do review every single prelim that I open. So if anything needs to be caught, if anything needs to be handled, I will tell you. And I will reach out to you and I will tell you my review of the preliminary title report. So just so that you guys know that, I do review all of my prelims myself.
Yeah, Nikki brought up an important point. So, like, it's important to know who's on title because, like, sometimes I'll get a phone call and say, "Oh, we're selling this property and I want to do a 1031," and then all of a sudden I find out, well, they're not on title. The actually title is held by a trust. They inherited the property with other parties, right? And they've been reporting this property underneath the trust for tax purposes, so they can't even do an exchange the way that the title is currently held. So it's really important to kind of get in front of that and probably is not a bad question to ask, when you're talking about listing the property for sale, which is like, how are you holding title to the property? If you're doing a 1031, you just remember that, hey, like the taxpayer that's selling this property has to be the same taxpayer that's buying the new property. So we just want to make sure that we, address those issues prior to getting, because it really could throw a huge snag into closing if you run into one of those issues. So ordering that advanced planning always key. When someone calls me up and says, "What are some pieces of advice that you can give me by doing an exchange?" Advanced planning. Why are you selling this asset? What are we trying to accomplish, right? Because you're buying and you're selling in the same market, right? So it's not like you're selling high and buying low, right? I mean, you see a little bit of that in today's market because some of the markets are starting to erode a little bit. Like you have Phoenix, and I don't know if you guys have ever, gone on the realtor.com and looked at how many listings are available in Phoenix, but there are a ton. Scottsdale, a ton. And so there are markets where they're deteriorating markets. Big Bear, they have a bunch of listings up there. Arrowhead's got a bunch of listings. That market, changed a lot because during COVID, right? Everybody was kind of VRBOing in places like Big Bear and Lake Arrowhead, they changed some of those laws, I think. And so it becomes a little bit more challenging. So you see people selling out of that market, 1031ing into markets that are more traditional. And so there is a little bit of that if they're going into different markets, but it's important, right? What are you trying to accomplish by selling this asset? Are we doing it for geographic reasons? Are we doing it for cash flow purposes? Are you trying to build your portfolio and, go from a duplex to 4 units? And if you are, where are you looking to buy those 4 units? Are there any on the market? Have any sold in the last 60 or 90 days? Do you need to expand your search into other markets that would allow you to look at more inventory? So it's really important. And I think it really changes the conversation that you're having with a customer because when you guys go into customers are like, what do you think my property's worth? And everybody is so sensitive on what the property is actually worth. And what I would do is kind of flip the script a little bit and say, okay, before we talk about property values, I know that you want to exchange. What are you looking to accomplish by doing this 1031? What are you trying to do? Are you trying to, like increase cash flow? Are you buying a property for your kids? Are you buying something you want to retire in ultimately? Are you looking to, so we kind of changed the topic of how much is my property worth? Because I think all of us on the call know that the market dictates the value of the property. I can list a property for whatever I want, but the market is going to tell me what it's worth, right? So, and so the market is the one that ultimately tells people what the property is worth. You get a good idea because you can look at data. Nikki can provide also that data of like what's sold and things of that nature. So you can get a pretty good idea of what that market, what that property is worth. But ultimately, The buyers are going to tell you what the property's worth. So have a plan in place. And then the second thing is be aggressive early in the transaction. Get something under contract, get it into escrow as quickly as you can so you can do your due diligence so you're not butting up against that 45 days. When I have a phone call with a customer, and I've had tons of them, that say, oh, so I just need to identify on my 45th day, do I need to have any of those properties under contract? And I say, no, you don't. But my opinion is if you don't have any properties under contract by your 45th day, you have a high likelihood of a failed exchange because you've got to buy one of the properties that are on that list. And if you don't, your exchange fails. And if you have not been able to put something under contract within the entire 45 days and you get to day 45 and now you're putting, 3 properties on a list or whatever, and we'll talk about the identification rules, you could be in trouble. So be aggressive early in the transaction, right? So you list this property for sale, just like you would any other property. Property goes under contract. In the contract, you want to put some exchange language. There's a CAR form that you can use. You can also just simply put the seller's intent is to complete a 1031, which will not delay the closing or cause any additional expense to the buyer. If you're going to negotiate an extension, this is where you do it. You receive an offer, you counter that offer with whatever terms. One of the terms that you're going to ask for is a right for the seller to extend escrow one time, let's say for 15 days, right? So you get it under contract. You open up an escrow just like you would on any other deal. It's just a sale, right? It's no different. The only other difference, right? So we have one thing, right? We got to add that language to the contract. And the only other difference is you have to hire a company like ours prior to the sale closing. So, because when the sale closes, the proceeds of the sale have to go to what's called a qualified intermediary, accommodator, facilitator, right? And you have to get that set up before the sale closes, right? It's very easy to get an exchange set up. You call me up, you go, hey, Greg, I've got a client that's doing an exchange. I can talk to the client, answer any questions that they have. And then if you put me in touch with escrow, we're going to get a copy of the contract, the title report, drop exchange docs, send those to your client to sign. Once they've signed those, the exchange is set up. Sale closes, proceeds of the sale come to us. We open up a for the benefit bank account for your customer, and then that 45-day period starts. Now, this is where our relationship and our affiliation, with Nikki's company and our parent company is very important. So our industry, not regulated. You don't have to be licensed or bonded to be in there. So, Akari, we'll see you later. Thanks for joining. So you don't have to be licensed or bonded. So anybody could open their own exchange company, right? And so because of that, right, you have companies that, don't do great things with the money. So anytime you're working with a customer, I mean, obviously we'd love for you guys to work with us, but you want to make sure that you work with a company that has sufficient assets and guarantees. Our parent company, which is the largest title insurance company in the country, they provide a $50 million performance guarantee. We have $100 million in fidelity bonding insurance. We have $30 million in E&O coverage. So when the money's sitting with us, it's safe, right? And so during the 45 days, you can make as many offers as you need to. In fact, I was doing an exchange myself. I made 9 offers in the first 45 days. But when you get to the 45th day, your client's got to write down the property addresses they're identifying, sign it, date it, send it to us. We're going to countersign it and date it and put it in their file. So there's 2 basic rules that someone can identify under. One is called the 3 property rule, which allows them to identify 3 properties, right? The value of those 3 properties doesn't matter, just limits them to 3, right? But what if you had a client that was selling a large asset and wanted to buy smaller assets? They were selling, let's say, a deal in, Palos Verdes, and it was $2.5 million. And they now live in Arizona, and they wanted to go buy a bunch of rental houses for $500,000 each. Well, at $500,000, if they got to spend $2.5 million, they're going to have to buy 5 properties. So obviously the 3 property rule is not going to work for them. So they can use this rule called the 200% rule. Now, there are 2 separate rules, right? The 200% rule says, hey, identify as many properties as you want, but the total aggregate value of those properties added together can't be more than twice the value of the property you sold. So if I sell for $2.5 million, I could identify $5 million worth of real estate. Well, guess what? If I'm buying $500,000 houses, well, how many is that? It's 10, right? So I can identify 10 properties underneath that, and I just had to make sure that I at least buy five of them to complete my exchange. So the 45 days is a good thing for a real estate agent. It creates motivated buyers, right? Someone, because, you've got somebody that's got to buy things, and buy something that they've identified. It's always interesting to me when I get a call from somebody that says, "Oh, well, I'm, I've got an offer from an exchange buyer. I'm not sure if I should take it." And I'm like, exchange buyers are usually the best buyer. Because if they don't complete their exchange, they've got to pay taxes. If I'm a cash buyer and I don't perform, well, I don't have any tax liability. It's just money that was sitting in the bank. So exchange buyers are typically great buyers. Remember, federal tax code, you can buy property anywhere in the US. California does have this thing called the clawback provision, but it's just a filing requirement. It doesn't, it still allows people to exchange out of California and defer the California tax. I want to talk about reverse exchanges. And that's kind of the topic we'll probably end on. Nikki maybe will pop in at the end and see if she can kind of recap some stuff on the title side. So a regular exchange, right? We have 45 days to identify the property we want to buy. We have another 135 days after that to close. So it's a total of 180 days. I do want to mention, and I did mention it before I go into reverses, the reinvestment rules, because those are important. So in order for a client to not pay taxes, they've got to buy something that's equal or greater in value to the net sales price of the property they sold. And they get to the net sales price by doing two things. By taking the gross sales price, reducing out things like real estate commissions, escrow, title insurance fees, that gives them their net sales price. It's not net of their loan, right? So if I sell for 2.5 million, let's say I have a $500,000 loan, and let's say I pay, I don't know, say I pay $150,000 in closing costs, right? So I have a $2.5 million sale. I've got $150,000 in closing costs. So my net sales price is 2,350,000. Okay. That's the number I need to go replace. And I also need to reinvest all of the proceeds I'm going to receive from the sale. And if I do those two things, I can defer all the taxes. But what if you had a client, and I had a client that just I talked to yesterday, they're selling an asset, they have a $200,000 loan, and they don't want to go get a new loan. And they don't have the cash to offset that debt. And so they're just going to buy something that's $200,000 less than they sold and buy something all cash. You can still do an exchange. You can still defer taxes, right? But you're going to pay taxes on that 200 grand. They call it mortgage boot or debt relief. We also have clients that want to take cash. They go, "Hey, I'm selling this asset, but I want $100,000. You can do that. So you can take 100,000. You're just going to pay taxes on the $100,000. So you can still do an exchange. You could still defer taxes. You're just going to pay taxes on that 100,000, which is called cash boot, right? So that's kind of the way that that works. So reverse exchanges. So a regular exchange we talked about, right? We sell, we use the proceeds from the sale to buy the new property. Reverse exchanges, we're buying the property that we want before we sell the property that we have. Now, the glaring challenge there is I have to have the cash available to buy this new property without selling the property that I have, right? So that's one of the challenges. The other challenge is that it's really hard to get a loan on residential property in a reverse exchange because we actually hold title to that property in an LLC. So what happens is, let's say it's just an all cash deal to make things simple. Let's say you have a listing, it's 2.5 million. Clients goes, "Hey, I really want to buy that property, but I've got this other property I'd really like to sell to 1031 into that." And you're like, "Well, I'm getting multiple offers on this deal. My seller's not willing to accept a contingent offer based on you getting your property sold." And the client goes, "Well, I've got capital, I've got cash available to be able to buy it without selling my property." They would be a good candidate for a reverse exchange. So they make an offer on your property just like they would any other. They get accepted, they open up an escrow, they hire us to become their, and what we do is we create an LLC that's going to step in and become the new buyer. We're the sole member of that LLC. We make the client the manager of it. So that LLC is going to step in and become the new buyer. The client's going to loan the money to the LLC to buy the property. Now, they don't send us the money, they send it to closing, but the LLC is going to show it as a loan. So we show that we owe this client $2.5 million. We close on the property. We then triple net lease it back to them. So we talked about that earlier when we were talking about Starbucks, right? We triple net lease the property to them. So your client, they keep insurance on it, they collect rents, they own the asset. We're just holding title. And then from the date we close, they have 45 days to identify what they'd like to sell, which typically is pretty easy. Then they have another 135 days after that to get it closed. So it's a regular flip-flop of an exchange. It's a 180-day period. So the property they're selling, let's say it goes under contract into escrow, we set that up like a regular 1031. So when that sells, the proceeds of the sale come to us. We use that money to pay off that note that your client has for $2.5 million. And then we then give them 100% interest in this LLC that's holding title to the property. We do an entity transfer opposed to a property transfer. And the reason we do it that way is to avoid double transfer taxes. So I do think that they would be required to get a binder policy because we're going to be the owner of that LLC. So I think Nikki would require that they get a binder policy, which would allow them to assume the policy when we transfer the ownership of the LLC to them. And that's kind of the way the reverse exchange works. So they are more expensive. So regular 1031, we charge a flat fee of $1,000. Reverse exchanges kind of start at $6,500 and kind of go up from there. If it was a $2.5 million deal, I think our fee is $7,000 plus LLC costs, which in California run about $1,200. So they're maybe in for $8,200. But we're doing more reverse exchanges right now than I've ever done in my career, which is really saying a lot because in 2021 and 2022, we were doing so many regular forward exchanges, like almost 2 or 3 times as many as we're doing now. And we were doing less than half of the reverses. So it tells me that even in today's market where there's more inventory and things are sitting longer, things that are listed on the market that are considered a good deal or very desirable sell quickly. And so in those kind of situations, a reverse exchange is a great tool for you guys to use to be able to take advantage of that. Now, please don't hesitate to use me as a resource. If you guys have questions, your clients have questions, you are not supposed to be an expert in 1031. You need to know enough to give them a kind of a 10,000 foot level view of it. And if they have a bunch of questions, then what you do is you get me on the phone. You say, you know what? Let me get you in touch with Greg. We'll get on a conference call and we'll be able to walk through this and answer any questions that you have. I am here to help, get the process along. And sometimes I get involved early in the transaction before you even get something listed for sale, and I tell clients, like I had a client called me this morning that says, oh, we're going to list our property tomorrow. What do we need to do? And I'm like, there's really nothing that you need to do from a paperwork standpoint until you're kind of in escrow. And a lot of times we wait till contingencies are removed. But certainly I'm here as a resource to answer any questions prior to that. So, just consider me like a 1031 resource. I'm going to send Nikki some like our booklet, our brochure, reverse exchange brochure, my V card. Definitely reach out to her and she can get you that information. What I would suggest you guys do, create a 1031 file folder on your desktop so that if somebody calls you and is talking to you and has some questions about 1031, you've got that thing at your fingertips and you can go, oh, you got questions about, an exchange? Let me send you a brochure. And also, 6 months from now, when you are, maybe talk to somebody about a 1031 and you're like, what was the name of that good looking guy that I saw on that, seminar? You'll have me on your desktop. So you'll go, oh, his name is Greg. So thank you guys for attending. Nikki, do you have any follow-up comments before we kind of sign off here?
Not really any follow-up comments. Like Greg said, I am a resource to you all as well. If you need any help trying to figure out who's on title, who you need to sign so that you can get the 1031 ball rolling with Greg, please let me know. I am more than happy to jump on a call with you, just like Greg is, and we're happy to get all that stuff for you. But thank you, Greg, for joining us today. I will send out all that stuff that Greg mentioned, so you all will have it. But thank you guys, and thank you, Greg. And if there's any questions, feel free to drop it in the chat or, reach out to us after, and we're happy to answer those for you.
Yeah, thank you guys.
Oh, there will be a recording available. That's a Rick question. Rick, if you want to jump in on that.
Yes, thank you, Nikki and Greg. There will be a recording available tomorrow afternoon, and Nikki will be able to send that to you. Also, I'll send her the link, so she can send it directly along with her contact information and Greg's.
All right. Well, thank you guys for having us.
Yes,
Okay.
thank you all so much. I hope you all have a great rest of your day, and any questions, let us know.
Okay. Thanks, guys. All right,
All
have a
right.
great
Take
day.
care.
Bye. Thank you.